Hello and welcome to this special edition of InvesTips from the CIO's desk. Today, I want to talk about how to manage market volatility. We have seen significant volatility since Trump announced widespread and sizable tariffs on exports to the US. What I want to do in this video is emphasize how important the investment decisions you make in the coming days and weeks are for your long-term outcomes, and give you some tips on how to manage yourself during periods like this. Let's start with some facts. We know that volatility, seen since Wednesday's announcement on April 2nd, has been severe. US stocks have led the move lower and were down over 10% in the 2 trading days after the tariff announcement on the 2nd. This has clearly unsettled a lot of investors and risks you taking actions that make you feel better today, but could be extremely damaging to your long-term financial gains. Therefore, it's important to remind yourself, firstly, that volatility is a normal state of affairs for markets. There are 3 key messages from this chart. First, equities go up twice as often as they fall in any given year. Second, so far at least, the US equity market decline we have seen is far from spectacular. Exactly half of the past 26 years have seen drawdowns worse than we've experienced so far this year. Now, I guess 5% declines for 2 days in a row is unusual, but the peak to trough correction of 17% so far is not unusual. Third, even within a year, such a decline does not necessarily result in losses for the full year. 2009 and 2020 are the best examples of this, where drawdowns of around 30% didn't stop them posting strong full year gains. The second thing to remember is the longer you hold investments, especially investments diversified across asset classes and geographies, the more likely they are to generate positive returns. This chart looks at the performance of equities, bonds, and a 60-40 equity bond portfolio over different time horizons since 1950. As you can see, the range of 1-year returns for a portfolio with 60% stocks and 40% bonds is minus 16% to plus 32%. Over 5 years, this range shifts to plus 1 to plus 20% per year, and for 20 years, it's plus 5% to plus 14%. Therefore, the longer the time period, the more likely you are to see positive returns. Third, buying after periods of market weakness generally improves forward-looking returns. This is true over longer periods of time, but can also be true over shorter-term horizons. Now, we're all human beings and we all face different behavioral biases, and on average, investors underperform because they sell after market weakness and buy after market strength. Morningstar places this underperformance at an annual 1.1%. This does not sound big, but if you compound over 20 to 30 years, the impact is huge. So what can you do about this? The first step is to understand yourself. If, like me, you get excited about markets going on sale, then I'm less worried about you. However, it is still important to remember the risks inherent in investing and not to be too narrow in your investments. The risk for somebody like you is overconfidence. However, the majority of investors I talk to get scared when their portfolios fall in value. If you fall into this category, then the following advice is critical. 1, make sure your investments are diversified. The same Morningstar research shows that the return for investors in multi-asset diversified funds track the performance of the underlying fund much more closely than for funds with much narrower exposures, such as equity sector funds. The reason? The volatility is lower, you're less likely to get scared and make decisions you'll later regret. Second thing, remind yourself this too shall pass. The more diversified you are, the more likely it is that losses will be temporary. And third, staying invested and adding or even accelerating investments into falling markets is the optimal long-term strategy. Okay, so what are some of the tricks of the trade that I use? So first, have some cash on the sidelines. This can help you think in terms of markets going on sale, such that not only do you not sell existing holdings, but you also buy items on sale. It can also help you sleep at night. Second, set up a default level of investments every month and accelerate into weakness if you can. And third, understand where you want to increase exposures and look for opportunities to add to that part of your portfolio. For instance, if you have a lower allocation to equities than you want to ultimately have, then prioritize these investments if equities weaken significantly. And finally, if you find that your investment roller coaster ride is too extreme, don't panic. Recognize it and have a plan to gradually reduce your exposures to equities. Don't throw out the baby with the bathwater. And of course, always learn from it to ensure you cap your exposure in the future so you don't have to learn the same lesson again and again. Now, a final note before I sign off. I guess in the relative serenity of watching this video, what I've taken you through is hopefully easily understood and something that sounds easy to follow. Unfortunately, we live in a very noisy world, which makes it much harder to stick with the plan. It's easy to get knocked off track by the negative news we are being constantly bombarded with. So when you feel the need to sell out of your diversified investments, breathe. This too shall pass. The human race has time and again proven its ability to deal with crises and come out stronger. Therefore, think about what your future self would thank you for. This will help guide you through the market volatility and achieve your financial goals. I hope you found this video useful. We would love to hear your feedback on how else we can help you, so please feel free to post in the comments section. I look forward to catching up with you again soon. Happy investing.